Hello and welcome to this Thursday's morning market briefing. We've got a lot to talk about, but firstly, the Federal Reserve holds interest rates steady as market focuses on timing of 2024 rate cuts, as well as the EU extends olive branch to Viktor Orbán to unlock Ukrainian aid package. We've got lots to talk about on the charts also, with lots happening on the economic calendar, but we'll come to that near the end, so make sure you stay around so you see that. Before we get straight into it, make sure to subscribe. The first article to talk about, of course, is the Federal Reserve. Now, yesterday, the Fed chose to hold interest rates at their all-time highs. This comes whilst investors have been expecting rate cuts in March. However, the Fed in this meeting gave little indication to its interest in when rate cuts were to begin. Now, we've been talking about the Federal Reserve a lot, and it's possibly the most visited kind of topic that we always come to in these briefings. And that's largely because, of course, the Federal Reserve dictates the US's monetary policy, which helps influence and basically drives the US equities markets, as well as the dollar, of course, and other associated pairs. And as a result of that, it's very important to understand what the Federal Reserve is thinking and what decisions they've made. And this article here basically, tells us about that key meeting that we were expecting for quite some time, the key, interest rate decision, which did take place yesterday, and ultimately it does seem like interest rates are staying where they are. Now, US interest rates have been in a very interesting position where basically going into the last half of last year, we were kind of expecting rates to stay higher for longer, and we were hearing a more hawkish tone from the Fed. However, as we did end off the year, the dovish rhetoric started to come out, and we did see a kind of change in the way the Fed was positioning itself in relation to markets. This was largely as a result of economic data presenting that growth was kind of waning, and we were seeing inflation come down far faster than really what economists were expecting. And so the Fed was obviously pleased to see this, and investors even more so, with investors then moving their rate cut predictions all way to as early as March, as the beginning of when rate cuts were to start happening, which was far earlier than we had thought just a month or two before that, when we were looking at rates actually going up before they were to come down. If you do take yourself back to kind of the months of September and October, we were expecting rate cuts to not happen at all, really. We weren't talking about rate cuts at the time, at least, and more so we were talking about the potential of a rate increase in the month of December. But obviously, as we've passed through that, we've seen that is very much not the case, and we're hearing a lot more dovish rhetoric. And so as we did approach this meeting, we were kind of listening out to hear those first signs of when rate cuts were to take place. We understand the Fed has made its own projections in regards to how much interest rates should or will be cut in the year of 2024, that being 0.75% for the whole year. That said, though, most investors are expecting far greater rate cuts than just 0.75%, with some even, predicting like 2% worth of rate cuts, which is a very large amount, to be honest. But ultimately, this is all still dependent on where the inflation level does reach in regards to, that 2% target, which the Fed does, assign to inflation. And ultimately, if we don't see, inflation come to that 2% target, then we can't be sure that the Federal Reserve will be happy even, bringing down interest rates at all, as ultimately their target has not been achieved. And at that point, there's still work to be done. And so we could be looking at rates staying where they are, or of course increasing. But, because of the lower levels of inflation that we have been seeing recently, that's why we've kind of seen, an increasing expectation of rate cuts earlier than what we might have previously expected. That said, the most recent pieces of inflation data for the last 2 months have been ones which are a bit more worrying and kind of presented a more hawkish message to investors, coming in above, previous levels of inflation. And also, 2 months back, that inflation rate did come in above what economists were expecting, which was a big worry to many investors which were betting on rate cuts in March. That said, Previous to this meeting, the predictions for the Fed to begin rate cuts in March was at a 60% level, and it will be interesting as we come to it in this article to note what they are now following this interest rate decision. So getting straight into it, the decision to hold rates at an all-time high, was a unanimous vote, and everyone agreed on it basically. The Fed did, however, indicate they wanted more time before choosing when to cut interest rates. So if we just take that at face value, that's starting to really give some hawkish messages and tones, because we're kind of going back to the era of when Jerome Powell, going into the end of last year, when we were still kind of hearing quite a bit of hawkish rhetoric, when they were kind of more so talking about rates staying higher for longer. They're waiting to see inflation figures, but that said, we have kind of been hearing this message for quite some time now from Jerome Powell, which has made it clear, in an effort almost to calm investors' expectations, that he wants to see inflation clearly reach or be coming close to that 2% target before interest rate cuts are basically even spoken about. So that's something that's definitely important to note. And they also made it clear that the Fed wants to see inflation near that 2% target before they start even talking about interest rate cuts, with the Fed also indicating they wanted more time before choosing when to cut interest rates. Overall, this rhetoric combated the early rate cut expectations of investors who had expected rate cuts to begin in March, which now seems unlikely. On the other hand, the Fed did also represent a more dovish tone by saying the next action by the Fed would most likely be a rate cut, not a hike. However, this is kind of just confirming the already known facts. We already were kind of expecting, a rate cut rather than a rate hike, and this is more so just confirming our suspicions, which obviously they couldn't confirm before, in an effort to, keep market expectations. In a position which wouldn't interfere with the Fed's monetary policy decisions, as obviously if market participants start expecting rate cuts super early, this can actually heat up the market, and basically affect the Federal Reserve's monetary policy making ability worse, just because they then aren't able to calm inflation as much as they might want to. The decision to hold interest rates at an all-time high was the fourth time that decision had been made in a consecutive month. The Fed officials continue to expect 75 basis points worth of cuts over 2024. Following the decision, stocks dropped slightly and bond yields rose, largely as a result of traders no longer expecting rate cuts in March. Before the decision, expectations for rate cuts in March were at 60% in the futures market. However, after the decision, that percentage dropped to 48%. So clearly, the market is seeing this meeting as one which kind of presented some clear hawkish tones, which will be interesting now going into the February meeting. Of course, we now need to wait a month, but ultimately, it's always kind of important after we get these kind of decisions and we hear this rhetoric to then immediately look to the next month and try and understand how this might affect next month's market movements. If we are kind of now in a more hawkish market perception, I guess we could be on a more like dovish side potential move. I'm wording it really bad, but ultimately we could have more of investors not seeing the more dovish signs going into the next meeting, and thus leave that open for certain investors. So that's something that's definitely important to note. Other US data was also released with figures indicating wage growth was moderating, with workers gaining an extra 4.2% on their wage over 2024, which is down from the 4.4% annual figure we saw in September, of course. So, that's something that's definitely important to note. Keep your eyes on the topic in relation to the Federal Reserve. Next article to talk about is to do with the EU, which is kind of trying to now deal with the Orbán situation, who obviously is someone which is more aligned with the Russian state and is more so, a kind of thorn in the side of the EU, which has been trying to pass funding packages for Ukraine as Ukraine continues its war effort to remove Russia from its territory. And as a result, Orbán has kind of blocked this, as he is representing a more right-wing populist movement within the EU, which somehow more so represents itself and aligns itself with the Russian state. The EU has now made an offer to the Hungarian Prime Minister Viktor Orbán to secure aid for Ukraine. This comes following Viktor Orbán vetoing the 50 billion euro, financial aid package to Ukraine. Now, obviously, we've been talking about the EU, and only last week, we actually spoke about how Sweden has finally been, kind of accepted to NATO, following Turkey now kind of turning over and accepting, Sweden's accession into the NATO alliance. And following that, we have now seen Hungary do the same, but we are waiting for a vote within the Hungarian kind of assembly for that decision to actually be made and ratified, and for then Sweden to join. So that's the kind of things that we've been talking about with Ukraine and Sweden and Hungary and the EU, and it largely relates to this article, because once again it represents Viktor Orbán kind of messing with the EU in any way he can, and it does seem that he's making these kind of political statements and kind of disrupting the processes within the EU simply for the sake of kind of representing Hungary's power in some way, or representing that Hungary is still sovereign within the EU. And this is all despite, of course, Hungary's reliance or kind of importance within the EU's economic chain. And obviously Hungary will probably not want to lose out on that, but ultimately Orbán is still kind of representing his power in any way he can to kind of disrupt the EU's efforts to fund Ukraine, or for NATO to admit Sweden into its alliance. And all these kind of ways that Orbán has kind of been messing with these Western alliances are very interesting, to say the least, and could even be kind of classed as a bit worrying. Now, all of this is coming at a time where US military aid for Ukraine has stalled in Congress, and this is obviously following an increasing rise of the kind of right-wing, more hardline right-wingers in the US kind of system, which are now kind of opposing support for Ukraine and messing with fund packages. And the change in the Republican speaker for the House of Representatives has also kind of disrupted that as well, and that's kind of weighing on the Ukraine's ability to deal with the issue at hand, which is Russia's invasion. Therefore, EU leaders have been mounting pressure on Orbán to secure the aid package. The new offer to Orbán, according to the FT, involves holding annual reviews of the next 4 years worth of aid to Ukraine once a year. However, no country will actually be able to veto the aid package. Reportedly, the EU will now attempt to get Orbán to agree by exploiting Hungary's economic vulnerabilities, which have since caused, this kind of attempt, or rumours of it, has since caused some backlash from Hungary. If this 50 billion euro 4-year package does fail to be secured, looking for alternatives will take a great deal of time and hurt Ukraine's war effort in the long run. The EU and Hungarian representatives seemingly are both open to compromises. However, others on both sides are looking for no veto 100% or 100% veto for sure. So there's people on both sides which kind of are willing to compromise, but it does seem like the Hungarian side are very much adamant on having that ability to veto those aid packages, which is very worrying for the EU. An option for the EU could be to strip Orbán of his voting rights if all nations agree. So that's something that's also something that's very interesting to note. We spent way too long on the articles though. Moving on from this, next to talk about is the charts, which we'll have to kind of get through at a quicker rate really, but there's lots to still talk about, of course. Now, firstly, we will be on the topic of the US 30 and US indices as a whole, as following the Fed's interest rate decision and the rhetoric which presented a more hawkish tone, we have since seen the US 30 sell off from its all-time highs and is now kind of retracing and nearing those key Fibonacci levels of the 3820 and the 50% just below it, pardon me. And this is obviously very interesting to note, as it just represents how investors are perceiving that federal interest rate meeting did go. As ultimately, we did talk about in the futures market how this has changed, that meeting has changed investors' perceptions in when the next rate cut would take place. And that's represented on the US 30 as well. And that's why we're seeing a sell-off really. The question is, how far will the US 30 now sell off? As ultimately, we have had a great deal of bullish momentum for the US 30 recently. And so to see that all sell off just as a result of some, Federal Reserve kind of worries and in relation to kind of a bit more hawkish rhetoric, is that really a fair kind of move in the market? I'm not sure. Ultimately, though, that is how investors are perceiving it for the time now. Definitely look out at those key. Definitely look out for those key Fibonacci retracement levels, though. Once price does interact with them, it'll be very interesting to see how price does move. Keep your eyes on that. Next to talk about though is the dollar, which is in a very interesting position if it can load up, that is, but simply because we are coming off the back of the Federal Reserve's interest rate decision, and we are seeing price kind of continue to hesitate and range, which is kind of surprising. We did expect some volatility one way or another following the meeting, but it does seem that the lack of kind of direction or or hawkish or dovish rhetoric has led to the dollar not moving too much. So that's something that's very interesting to note, and it kind of leaves the US dollar open to the coming economic data over the next few weeks, and it leaves it vulnerable to the data over the next few weeks, as ultimately if the dollar hasn't moved based on that meeting, it's now going to be very, very vulnerable to moves in relation to wage growth, in relation to unemployment, which of course is a figure that we're getting on Friday, and I'm sure that'll be pushing the dollar greatly. So keep your eyes on the dollar and listen out for that key economic data. Staying on the topic of the dollar though, Euro USD is to talk about. Not too much to say though on the Euro USD. Not too much movement despite the Federal Reserve's interest rate decision. And we've just seen, Euro USD kind of hesitate, range, not do too much too interesting. Still keep your eyes on Euro, as we are sitting on a long-term Fibonacci level of the 78.60. Keep your eyes on that. Next to talk about is pound yen, which is an interesting position for sure, since recently it kind of stalled out at those all-time highs as marked out with this liquidity zone. Price kind of came up to there, stalled around, struggling to break higher, and since then we've kind of seen a slow sell-off from that area. This does, however, kind of represent more of like a retracement action rather than like an actual bearish sentiment or change in sentiment for pound yen, and therefore we could definitely be looking at upside opportunities from where pound yen is currently moving. If we do kind of just set up some positions here, some analysis in regards to where the next level of liquidity could be in relation to that Fibonacci level. We've obviously got that 3820, which I've just drawn out, but also that key 50%. So it will be interesting to see how price does move over the next coming days. Definitely keep your eyes on pound yen. Lots of upside potential based on this retracement action. Next to talk about is Bitcoin. Not too much to say on Bitcoin really, as it does kind of continue to consolidate, and this is at some recent highs after Bitcoin moved to the upside following a deep sell-off following the ETF approval by the SEC. Not too much to say though on Bitcoin. Definitely keep your eyes on it though nonetheless. Next to talk about is gold, which has obviously been a very important asset recently as a result of raising world tensions in regards to Israel and the Middle East as a whole, as well as Russia's invasion into Ukraine, and even with China and Taiwan, and that's all been weighing on gold. But as well as that, we've had many key parts of pieces of economic data and kind of news in relation to the economy. And we obviously had the Federal Reserve's interest rate decision yesterday, and that did cause some volatility on gold. That said, it hasn't actually caused gold to end on the upside or downside on the daily candle. So price hasn't actually moved that much in regards to where it was before. So maybe price is going to stay around where it is right now. Still keep your eyes on gold though. Lastly to talk about is oil, of course, which has been super interesting recently because of the tensions in the Middle East and how that's been affecting oil's price, with obviously issues within the Red Sea causing oil not to topple over and move to the downside as was previously expected. And then obviously we had US troops die in Jordan. Now we're expecting counter strikes by the US. And all these kind of world tensions, all these kind of regional tensions, more like within the Middle East, have weighed on oil's price and caused oil's price to kind of surge recently, with it making its way all the way up to the highs that we were seeing around the end of November. Since then, price did sell off, and now price is nearing around that 50% Fibonacci mark. Keep your eyes on these key levels for price to interact with, and then we can see where price may go from there. Keep your eyes on oil and the charts as a whole. We've got to quickly get through the economic calendar though, as we've spent way too long. Charts of blacked out. We may have to leave. Sorry about that, guys. We'll continue nonetheless, but we'll get through this quickly. So firstly, we will be getting Eurozone, German, French, Spanish and Swiss manufacturing figure, as well as the Eurozone and Italian inflation rate figure. Along with that, we're getting the Eurozone unemployment rate figure and the Bank of England's interest rate decision. So some key European data today, especially in regards to the Eurozone, but also with the Bank of England and the pound, as we are hearing that, as we will be hearing from the Bank of England on their interest rate decision, and also getting some key rhetoric in regards to their monetary policy. As well as that, we're having the US continuing jobless claims data being released, along with the ECB President Lagarde speaking as well. So that's important to understanding ECB monetary policy as well. And then finally, we'll be having the US's and Canadian manufacturing figure. But that's all to talk about on the economic calendar. We've spoken about a lot on the articles, lots on the charts, and lots on the economic calendar. That's all from us at Wildwood Capital. Have a great trading day and a great rest of your week. See you tomorrow. That's all from us. See you later. Bye.